Welcome to the exciting world of technical analysis. If you've ever looked at a stock chart and felt a rush of excitement, or maybe a touch of bewilderment, you're in the right place. Technical analysis can seem like a secret language, full of strange lines and indicators, but it's a language worth learning. It's the key to unlocking the secrets of market movements and making more informed trading decisions. In this video, we'll embark on a journey together to demystify technical analysis. Whether you're a complete novice or have some trading experience under your belt, our goal is to equip you with the knowledge and confidence to navigate the markets like a pro. We'll break down complex concepts into bite-sized pieces, using clear explanations and real-world examples to illustrate our points. Remember, technical analysis is not about predicting the future with absolute certainty. Instead, it's a powerful tool that helps us understand the probabilities and make calculated decisions based on historical data and market psychology. By the end of this journey, you'll have a solid understanding of the core principles of technical analysis and be well on your way to mastering this essential trading skill. So grab your notebooks, buckle up, and let's dive into the fascinating world of technical analysis together. Don't forget to like this video, subscribe to our channel, and hit the notification bell so you don't miss out on our upcoming lessons. Let's get started. At the heart of technical analysis lies the chart, a visual representation of a security's price movements over time. Think of it as a map that guides us through the landscape of the market. Just like a map uses symbols and colors to represent different features, charts use various tools and indicators to reveal patterns and trends. We'll learn to read these charts like seasoned navigators, identifying key support and resistance levels, spotting emerging trends, and recognizing classic chart patterns that often precede significant price moves. Understanding the language of charts is crucial because it allows us to interpret the story the market is telling us. But technical analysis goes beyond simply reading charts. It delves into the psychology of the market, recognizing that crowd behavior often drives price movements. By studying past patterns and indicators, we gain insights into the collective sentiment of traders and investors, allowing us to anticipate potential future moves. Just as a conductor interprets musical notes to create a symphony, technical analysts interpret market data to understand the rhythm and flow of price action. Through careful observation and analysis, we can identify potential trading opportunities and manage our risk effectively. In the ever-changing world of finance, knowledge is power, and technical analysis is a powerful tool that empowers traders with valuable insights. By understanding the principles of technical analysis, we gain a significant edge in the markets. Instead of relying solely on gut feeling or speculation, technical analysis provides a structured framework for making informed trading decisions. It allows us to approach the markets with a calculated strategy, minimizing emotional biases and impulsive actions. By identifying trends, patterns, and potential reversals, technical analysis helps us time our entries and exits more effectively. It provides us with objective criteria for setting stop-loss orders to manage risk and take-profit orders to secure profits. Whether you're a day trader looking for quick profits or a long-term investor seeking sustained growth, technical analysis is an invaluable skill that can significantly enhance your trading performance. Technical analysis is like deciphering a secret code, and chart patterns are some of the most intriguing clues. These patterns, formed by the ebb and flow of price action, offer a glimpse into the collective psychology of the market. They reflect the balance between buyers and sellers, revealing shifts in sentiment and potential future price movements. Imagine a tug of war between bulls, who believe the price will rise, and bears, who anticipate a decline. Chart patterns visually represent the struggle between these opposing forces, highlighting moments when one side gains the upper hand. By learning to recognize these patterns, we gain valuable insights into the prevailing market sentiment and can anticipate potential breakouts or reversals. It's like observing the body language of the market, understanding its cues and signals. Remember, chart patterns are not foolproof predictors of future price movements. However, they provide valuable clues that, when combined with other technical indicators, can significantly enhance our trading decisions. One of the most recognizable and reliable chart patterns is the head and shoulders pattern. As its name suggests, this pattern resembles a head flanked by two shoulders, with the neckline acting as the base. The head and shoulders pattern is typically considered a bearish signal, indicating a potential trend reversal from bullish to bearish. The pattern forms when the price rallies to a new high, the left shoulder, followed by a retracement and then a surge to an even higher high, the head. Another retracement occurs, followed by a rally that fails to reach the head's high, forming the right shoulder. The neckline, drawn connecting the lows of the two shoulders, acts as a crucial support level. A break below the neckline, often accompanied by increased trading volume, confirms the bearish signal and suggests a potential downward trend. The distance between the head and the neckline often provides a price target for the potential decline. Traders often look for short selling opportunities after a confirmed neckline break in a head and shoulders pattern. Like the head and shoulders pattern, double tops and double bottoms are powerful chart patterns that signal potential trend reversals. As their names imply, these patterns involve two consecutive price peaks, a double top, or troughs, a double bottom, at roughly the same price level. A double top pattern, typically a bearish signal, forms when the price rallies to a certain level twice but fails to break through on the second attempt. This suggests a weakening of bullish momentum and a potential shift in sentiment towards the downside. Conversely, a double bottom pattern, a bullish signal, occurs when the price drops to a support level twice, but rebounds on both occasions. This indicates strong buying pressure at that level and suggests a potential upward trend reversal. Traders often look for trading opportunities when the price breaks above the neckline of a double bottom for long positions, or below the neckline of a double top for short positions. Remember, confirmation is key. Traders often look for increased trading volume or other technical indicators to confirm the reversal signal before entering a trade. Mastering chart pattern recognition is like adding a powerful weapon to your trading arsenal. By understanding the psychology behind these patterns and their implications for future price movements, you gain a significant edge in the markets. Remember, chart patterns are not standalone trading systems. They are most effective when used in conjunction with other technical indicators, such as moving averages, oscillators, and volume analysis. By combining these tools, you can create a robust trading strategy that helps you identify high-probability trading opportunities. As you gain experience in technical analysis, you'll develop an eye for spotting these patterns and interpreting their significance. The more you practice, the more confident you'll become in your ability to read the language of the market and make informed trading decisions. In the next section, we'll delve into the fascinating world of trend analysis, exploring how to identify and capitalize on market trends. In the dynamic world of trading, trends are like powerful ocean currents that can carry us towards our financial goals. Just as a surfer rides a wave to shore, skilled traders identify and capitalize on market trends to maximize their profits. Trends are the underlying direction of a security's price movement over time. They can be upward, downward, or sideways. Understanding trends is essential for successful trading because it allows us to align our trades with the prevailing market forces. Trading with the trend significantly increases our probability of success. It's like sailing with the wind rather than against it. By identifying the direction and strength of a trend, we can time our entries and exits more effectively, ride the wave of momentum, and maximize our profit potential. Trend analysis provides us with a clear roadmap, guiding our trading decisions and helping us navigate the often volatile waters of the market. Remember, trends can last for varying periods, from short-term intraday fluctuations to long-term secular movements. The key is to identify trends across different timeframes and adjust our trading strategies accordingly. Identifying uptrends and downtrends is the foundation of trend analysis. An uptrend is characterized by a series of higher highs and higher lows, indicating increasing buying pressure. Conversely, a downtrend is defined by a series of lower highs and lower lows, reflecting increasing selling pressure. To identify an uptrend, look for a pattern where each successive peak is higher than the previous peak, and each successive trough is higher than the previous trough. Connect these peaks and troughs with trend lines, which act as support and resistance levels. Conversely, to identify a downtrend, look for a pattern where each successive peak is lower than the previous peak, and each successive trough is lower than the previous trough. Again, connect these peaks and troughs with trend lines to visualize the downward channel. The strength of a trend can be gauged by the steepness of the angle of ascent or descent. A steeper angle suggests a stronger trend, while a flatter angle indicates a weaker trend. Remember, Trends rarely move in a straight line. There will be periods of consolidation or pullbacks within a trend. However, as long as the overall pattern of higher highs and higher lows, or lower highs and lower lows, remains intact, the trend is considered valid. Trends often move within channels, which are areas of price action bounded by parallel trend lines. These channels provide valuable insights into the potential future direction and extent of a trend. An ascending channel, formed by an upward sloping trend line connecting the lows and a parallel trend line connecting the highs, indicates a bullish trend. Traders often look for buying opportunities near the lower trend line and selling opportunities near the upper trend line. Conversely, a descending channel, formed by a downward sloping trend line connecting the highs and a parallel trend line connecting the lows, signals a bearish trend. Traders may consider short selling opportunities near the upper trend line and covering their positions near the lower trend line. Channels can help us determine the potential extent of a trend. A breakout above the upper trend line of an ascending channel or below the lower trend line of a descending channel often signals a continuation of the trend in the breakout direction. Remember, channels, like all technical analysis tools, are not foolproof. It's essential to confirm breakouts with other indicators, such as increased trading volume or candlestick patterns, to avoid false signals. Imagine navigating a ship through vast oceans using only a compass. While the compass provides a sense of direction, it doesn't reveal the depth of the water, the strength of the currents, or the proximity of hidden reefs. Similarly, chart patterns and trend lines provide valuable insights into market direction, but they don't tell the whole story. This is where technical indicators come into play. These mathematical calculations, derived from a security's price and volume data, act like sophisticated navigational instruments, providing us with deeper insights into the market's dynamics. Technical indicators help us confirm the validity of trends, gauge the strength of momentum, identify potential overbought or oversold conditions, and anticipate potential trend reversals. They add layers of depth and nuance to our analysis, enabling us to make more informed trading decisions. Just like a seasoned captain relies on a suite of instruments to navigate safely and efficiently, skilled traders utilize a combination of technical indicators to gain a comprehensive understanding of the market's current state and potential future direction. In the world of technical analysis, moving averages are like noise-canceling headphones, filtering out the daily fluctuations of price action and revealing the underlying trend. They are calculated by averaging a security's price over a specific period, smoothing out short-term volatility, and highlighting the long-term direction of the market. The two most common types of moving averages are the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all prices within the specified period, while the EMA gives more weight to recent prices, making it more responsive to current market movements. Traders often use moving averages to identify support and resistance levels, confirm trend direction, and generate trading signals. For example, a buy signal is generated when the price crosses above a moving average, while a sell signal occurs when the price crosses below the moving average. The choice of moving average period depends on the trader's time horizon and trading style. Shorter periods, such as 10 or 20, are more sensitive to short-term fluctuations, while longer periods, such as 50 or 200, provide a smoother representation of the long-term trend. Imagine a pendulum swinging back and forth. As it swings higher, its momentum increases, but eventually, gravity pulls it back towards the center. The Relative Strength Index, or RSI, an oscillator that measures the magnitude of recent price changes, works similarly, indicating the strength of momentum and potential overbought or oversold conditions. The RSI oscillates between 0 and 100. Readings above 70 are generally considered overbought, suggesting that the price may be due for a pullback or correction. Conversely, readings below 30 are considered oversold, indicating that the price may be poised for a bounce or rally. Traders often use the RSI to confirm trend reversals, identify potential entry and exit points, and gauge the strength of momentum. For example, a bearish divergence, where the price makes a higher high, but the RSI makes a lower high, suggests weakening bullish momentum and a potential trend reversal to the downside. Remember, the RSI is a momentum indicator, not a trend-following indicator. It's essential to use the RSI in conjunction with other technical indicators, such as moving averages or trend lines, to confirm trading signals and make informed decisions. The moving average convergence divergence, or MACD, is a versatile indicator that combines elements of trend following and momentum. It consists of two moving averages, the MACD line and the signal line, which fluctuate around a zero line, providing insights into trend changes and generating trading signals. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. The signal line is a 9-period EMA of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting that upward momentum is increasing. Conversely, a bearish signal occurs when the MACD line crosses below the signal line. The MACD histogram, which plots the difference between the MACD line and the signal line, provides a visual representation of the convergence and divergence between these two lines. A widening histogram suggests increasing momentum, while a narrowing histogram indicates decreasing momentum. Traders often use the MACD in conjunction with other indicators, such as candlestick patterns or support and resistance levels, to confirm trading signals and make informed decisions. It's a powerful tool that can help us identify trend changes, gauge the strength of momentum, and anticipate potential market reversals. Imagine a river flowing steadily in one direction. Suddenly, it encounters a bend, causing the current to shift and the water to flow in the opposite direction. Similarly, in financial markets, trends, while powerful, don't last forever. Market reversals, those pivotal moments when the balance of power shifts between buyers and sellers, mark the end of one trend and the beginning of another. For traders, identifying these reversals is crucial. It allows us to exit existing trades profitably before the tide turns against us and positions us to capitalize on emerging opportunities in the new trend. However, recognizing reversals in real time can be challenging. The market often sends mixed signals, making it difficult to differentiate between a temporary pullback within a trend and a genuine trend reversal. Mastering the art of spotting reversals requires a keen understanding of market psychology, a watchful eye for telltale chart patterns, and the ability to interpret technical indicators effectively. By combining these skills, we can navigate the shifting tides of the market with greater confidence and potentially enhance our trading performance. In this section, we'll delve into the world of market reversals, exploring various techniques and tools that can help us identify these crucial turning points, manage our risk effectively, and seize new trading opportunities. In the realm of technical analysis, candlestick patterns are like ancient hieroglyphics, each unique formation telling a story about the battle between bulls and bears. While individual candlesticks provide insights into short-term price action, specific candlestick patterns, especially those occurring at significant support or resistance levels, can act as powerful harbingers of potential market reversals. Consider the hammer and the shooting star, two classic candlestick patterns that often signal potential trend reversals. A hammer, characterized by a small body and a long lower shadow, typically occurs after a downtrend. It suggests that sellers drove the price lower during the session, but buyers emerged forcefully, pushing the price back up towards the opening price. Conversely, a shooting star, resembling an inverted hammer, typically forms after an uptrend. It indicates that buyers initially pushed the price higher, but sellers gained control, driving the price back down towards the opening price. The long upper shadow suggests strong selling pressure. These are just two examples of the many candlestick patterns that can signal potential reversals. By learning to recognize these patterns and understanding the psychology behind them, we gain valuable insights into the shifting balance of power between buyers and sellers. Remember, candlestick patterns are most effective when confirmed by other technical indicators or analysis techniques. They provide valuable clues, but should not be relied upon in isolation. Imagine this. At auction, a rare item comes up for bid, and the bidding starts slowly. Suddenly, multiple bidders engage, enthusiastically raising their paddles, driving the price higher with each bid. This surge in activity and the willingness of bidders to pay a premium signal strong demand for the item. Similarly, in financial markets, volume, the number of shares or contracts traded over a given period, acts as a crucial confirming indicator. It reflects the conviction behind price movement and can help us differentiate between a genuine trend reversal and a false signal. When volume increases in the direction of a price move, it confirms the strength of the trend. For instance, during an uptrend, rising prices accompanied by increasing volume indicate strong buying pressure and suggest that the trend is likely to continue. Conversely, when volume declines as the price moves in the direction of the trend, it suggests weakening momentum. This divergence between price and volume can be an early warning sign of a potential trend reversal. By incorporating volume analysis into our trading strategy, we gain a deeper understanding of the forces driving price movements and can make more informed decisions about our trades. In the world of technical analysis, identifying market reversals is like solving a complex puzzle. Each piece of information, from chart patterns to technical indicators to volume analysis, provides a clue, but it's the ability to combine these clues into a cohesive picture that unlocks the solution. Relying on a single indicator or pattern in isolation can be misleading. Market reversals are rarely straightforward. False signals and temporary retracements within a trend can often mimic genuine reversals, leading to poor trading decisions. A holistic approach, one that considers multiple factors and confirms signals across different timeframes, is essential for increasing the probability of successfully identifying and capitalizing on market reversals. By combining candlestick patterns with technical indicators like the RSI or MACD, confirming signals with volume analysis, and paying attention to support and resistance levels, we can build a robust framework for spotting those pivotal moments when the market's direction is about to change. Remember, mastering the art of identifying market reversals takes time, practice, and a willingness to continuously learn and adapt. By honing our skills and developing a disciplined approach to analysis, we can navigate the ever-changing landscape of the financial markets with greater confidence and potentially achieve our trading goals. Now, let's consider timeframes in technical analysis, from minutes to months. Imagine a photographer adjusting their camera lens, zooming in to capture the intricate details of a flower, and then zooming out to encompass the vastness of the surrounding landscape. Similarly, in technical analysis, timeframes act as our lens, allowing us to analyze price movements with varying levels of granularity, from the minute-by-minute fluctuations of intraday trading to the long-term trends spanning months or even years. The choice of timeframe depends on our trading style and investment horizon. Short-term traders, seeking to profit from intraday price swings, might focus on minute or hourly charts, while long-term investors, aiming to capitalize on broad market trends, might prefer daily, weekly, or even monthly charts. Each timeframe tells a different story, revealing patterns and trends that might not be visible at other timeframes. By analyzing price action across multiple timeframes, we gain a more comprehensive understanding of the market's dynamics and can make more informed trading decisions. Remember, the key is to align our chosen timeframe with our trading objectives and risk tolerance. Shorter timeframes offer more trading opportunities, but also come with increased noise and false signals, while longer timeframes provide a clearer picture of the overall trend, but with fewer trading opportunities. In the fast-paced world of intraday trading, minutes matter. Prices fluctuate rapidly, driven by news headlines, algorithmic trading, and the ebb and flow of short-term traders' sentiment. Intraday charts, those displaying price movements on timeframes of minutes to hours, provide a window into this dynamic environment, allowing us to identify short-term trading opportunities. However, navigating the short-term noise of intraday charts requires skill and focus. False signals and whipsaw movements are common, and reacting impulsively to every price fluctuation can lead to costly mistakes. Successful intraday trading relies on a combination of technical analysis, discipline, and a deep understanding of market psychology. Traders need to be able to filter out the noise, identify high-probability setups, and manage their risk effectively. Technical indicators, such as moving averages with shorter periods, oscillators like the RSI or stochastic, and candlestick patterns, can be particularly useful in intraday trading, providing insights into momentum shifts and potential trend reversals. Remember, intraday trading is not for everyone. It requires a high level of commitment, risk tolerance, and emotional resilience. If intraday charts are like magnifying glasses, then daily, weekly, and monthly charts are like telescopes, allowing us to zoom out and observe the grander movements of the financial markets. These longer-term timeframes filter out the short-term noise and reveal the underlying trends that drive asset prices over weeks, months, or even years. For investors and traders with a longer-term perspective, these timeframes provide a clearer picture of the market's overall direction and help identify potential investment opportunities. Trends identified on daily, weekly, or monthly charts tend to be more reliable and offer a higher probability of success. Technical analysis techniques, such as trend lines, support and resistance levels, and moving averages with longer periods, are particularly effective on these timeframes, helping to confirm the trend, identify potential entry and exit points, and manage risk. Remember, the choice between short-term and long-term trading is a personal one, depending on individual risk tolerance, investment goals, and time commitment. However, understanding the different perspectives offered by various timeframes is crucial for all traders and investors. By incorporating a multi-timeframe approach into our analysis, we gain a more comprehensive understanding of the market's dynamics, improve our ability to identify high-probability trading opportunities, and make more informed decisions that align with our overall trading goals. As we conclude this exploration into the world of technical analysis, remember that the journey doesn't end here. The world of trading is dynamic and ever-evolving, requiring continuous learning, adaptation, and refinement of your skills. Like any craft, mastering technical analysis takes time, dedication, and a willingness to embrace both successes and setbacks as valuable learning experiences. The knowledge and tools we've discussed are your compass and map, guiding you through the exciting and sometimes challenging landscape of the financial markets. As you gain experience, you'll develop your own trading style, identify the indicators and patterns that resonate most with you, and learn to navigate the markets with increasing confidence and skill. Remember, trading involves inherent risks, and past performance is not indicative of future results. The information shared in this video is for educational purposes only and should not be considered financial advice. Always conduct thorough research, seek guidance from qualified financial professionals, and never invest more than you can afford to lose. Thank you for joining us on this journey into the world of technical analysis. We're excited to see you apply these tools and techniques to your trading endeavors. Don't forget to like this video, subscribe to our channel, and hit the notification bell so you don't miss out on our upcoming trading lessons and insights. Until next time, happy trading.